Aloha, guys. This is our attempt to give you the banking game. Richard Warren, or sorry, believe me last, Richard Werner. His recent podcast with Tucker Carlson.
Uh, you're one of the best known economists in the world, most significant, but you have a story that I think that I didn't know. And let me just summarize what I understand of it, and then I'm just going to turn it over to you to tell the whole story. So it's the 1990s, you're living in Japan, a consultant to the Bank of Japan, you speak Japanese. And in 2001, you publish a book about the banking system in Japan. In Japanese. It's not published in English. It's only published in Japanese in Japan. And that book about the Central Bank of Japan and explaining why the country is in this protracted recession becomes number one in Japan, which is kind of amazing, even in Japan, beating Harry Potter. And then your life changes completely. I think this is one of the more significant stories that I hadn't heard. So if you don't mind, if you could take it from there.
That goes over how the banking system actually works. He's been yapping on about it for ages and ages and saying that traditional economists and even not so traditional, Bob Murphy, him and his Mises Institute, his reaction to the more publicized Richard Werner podcast with Tucker Carlson, obviously.
My quick, just overall reaction to it is, yeah, there is a lot in here. Let me put it to you this way, Jonathan. I was concerned that my initial gut reaction, because right out of the chute, Tucker introduces him as, and at first I thought he said the most famous economist in the world, and then I re-listened to it, and he said something like one of the world's most famous economists, something like that. I hope this doesn't rub you the wrong way, Jonathan. I checked. You have more Twitter followers than this guy does. And so, no, he cannot be one of the world's most famous economists if that's a true statement. So I'm curious, have you heard of, like when you heard like, oh, Richard Werner is on Tucker, were you like, oh, I want to go see what he's, or did you say, who? Did you, like, because my honest reaction, I didn't know his name. It didn't ring a bell when I first heard it.
Obviously, they're a little butthurt because, again, they have also been at it for a very lengthy time trying to tell everyone how the banking system actually works and try to get a grasp on it so that someone's educated enough to actually fix this big mess. Nonetheless, we're going to go over why we believe Richard Werner is about 80% correct. Some of Bob Murphy's criticism and the Mises Institute's criticism on Richard Werner's definitions and defining how the banking system works is pretty clear for some of the points, but the main concept is getting missed of what Richard Werner's main credit creation bank theory compared to the normal fractional bank theory that everyone knows. We'll get into both why Richard Werner is missing some things, and some of them Bob Murphy already points out, but we'll also get to why Bob Murphy is actually missing half of the full picture and why Richard Werner, the top economist, is more on to the thread than either one of these are. And I'm no one. The authority in this is that, again, I'm a third-generation contractor and then grew up, joined the Marines, got into real estate investing, and then created the home equity invoice agreement. That's what I mainly do, and then I'm on a side quest on this Foreclosure War podcast to correct the banking game, not through legislation, not through teaching people or trying to teach people how it works, but to actually give and empower the everyday people, the economy, how everyone keeps saying that that's the main goal, but to give them the tools and the knowledge and the base to say, oh, well, I understand this and I can go change this and fix this through other means than trying to control the banking system. Trust me, even the Federal Reserve has barely got a grasp on it. And I think they're finally waking up to that, as you can see in the previous recent years, that I think both of these guys are misunderstanding and not awake to the current news. So hopefully this actually can get through you. So while we're here, please like, subscribe, and share this to Richard Werner, Bob Murphy, and then also Tucker Carlson. We will get down to Catherine Fitz. I think she has more of like a 98 or 99%, more understanding of everything that's going on.
What's the purpose of the Bank of International Settlements?
Okay, so there are two things you need to know about the Bank of International Settlements. It has sovereign immunity.
What does that mean?
It's above the law.
It's its own country.
Right. It's its own country. It has its own police force. And essentially, other than one of its staff being in a car accident or, minor things, no one has the legal authority to move against it. Okay? It has sovereign immunity. That's number one. Number two, it can move money and hold it on its balance sheet and manage money secretly. So if I want to, I'm grossly oversimplifying, if I want to steal 21 trillion from the US government and park it on the balance sheet of the BIS, it can move it anywhere in the world and it can keep it on its balance sheet secretly.
I don't know. So that's a little bit far reach to see if that's the actual motive or where we're going. But she has more government ties to get an actual response instead of from two economists, but from someone that's actually been involved in the government and whatnot. And not just the Federal Reserve, which is also obviously a biased situation. Why it's biased, we'll get into that. So let's start with the three types of banks. Richard Werner gets into it. He pretty much is a big part of the Princes of Yen. It's a movie you can go watch about Japan. And why their housing and their economic gaming, banking system just created so much mess for their economy. For the UK, you can watch The System of Money, same situation, again, a lot of these banking games and systems play exactly how they play out in every other country. You can go through the history on that inside the Tucker Carlson podcast with Richard Werner, but for the money mechanics, I think it's modern money mechanics. I wouldn't say it's so modern anymore. That was actually released by the Federal Reserve, and that is more of a book than a movie. These two are movies. This is a book. And if you want our real estate book, it's The Real Game Made Simple, which you can grab at that QR code. But nonetheless, so Richard Werner says, hey, for the banking system, everyone believes it's an intermediary type of bank, where you have a bank, you got a customer, this customer has, and we'll try to start off with back in the day so that you can kind of see a little bit of the history. I'm not going to get in full in the history, but you can see how things evolved with this and why it got so diluted of what's right and what's wrong. This guy says, hey, bank, can you hold my 100 ounces of gold? So this bank gets 100 ounces of gold. And here, I'm going to do what is referred to as double accounting entry. This is something that both Werner and Murphy agree on as the double accounting entry. And I think if any business owner out there and has done counting your taxes or has done any kind of debt loan situation to someone, they understand how that works. But they don't understand how it also works with the banking system, to where, oh shit.
What Werner just said there, sort of intuitively to Tucker, was unpacked in terms of the actual accounting and bookkeeping.
So what I'm saying in this slide here, look at this carefully. There's still 100 ounces of gold in the vault, and the bankers are still counting that as assets. And now, on top of that, the bankers are counting the 90-ounce IOU from Guido as an asset too, because in their mind they're saying, no, this is a legally binding contract he just signed with us. And he's a smart guy. He's going to come up with the money. Even if that weird book he's writing doesn't pan out, he's probably going to just go shake somebody down for it. So we're going to get paid. So this is clearly an asset. And we still have the 100 ounces in the vault. And the way these fractional reserve bankers work, they think money in the vault is our money. We can, that's our asset. So the asset side is 190. So we know because of the double entry bookkeeping, it's got to be the case that the liabilities and shareholder equity have to equal 190. And so where does that come in? Well, right now, there's still no equity, okay? Because nothing is, all the bank has done is made a loan. That per se doesn't earn them income. They earn income over time through interest accrual. So right now, at the moment of giving that loan to Guido, they haven't earned anything. So where that 190 comes from on the right-hand side is the fact that Billy still thinks the bank, that he has a claim on the bank of 100 ounces of gold. At any time he wants to, he can either write checks or he can show up and withdraw his money. So when the bank, legally speaking, wants to say, what are our liabilities? Well, Billy has the right to withdraw 100 ounces of gold, but so does Guido. Okay? So it's true, Guido didn't walk out of the bank. He didn't want to walk out with 90 ounces in metal, but he could have if he wanted to. And now with his checking account, if he wants to, he can go to a bank and write it out to cash. You know, if you've ever done that, if you write a check out to cash and give it to the bank, they give you cash for it. Okay, so he can do that if he wants. It's just he doesn't want to do that right now. And in any event, if he writes checks to merchants in the community, then this bank is going to be obligated, if the people who get those checks want, to hand over physical gold. Okay, so now the assets and liabilities are 190 ounces. So when we talk about, you know, so notice what happened here is the bank's balance sheet expanded or grew because of granting the loan to Guido. And that's why I did it this way. I didn't want, you know, because probably most of you, when you hear examples like this, you're thinking, okay, first there's 100 ounces in the vault, and then they took out 90 and gave it to Guido, and he walked away. But what I'm trying to isolate and show you is no, the first thing that happens conceptually in terms of the accounting is the mere granting of a loan to Guido all of a sudden increases both sides of the balance sheet. And to the extent that Guido may not withdraw the money, then at that point in time, in that period, the money supply or the money stock in this community is now bigger. And what do I mean? Well, I'm saying to the extent that we consider checking account balances or demand deposit balances part of the money supply or the money stock, clearly it's gone up by 90 ounces.
They also are doing this, and then when they do it, obviously it changes things that they can leverage and move around and utilize. That has value in the game. This guy has 100 ounces. He brings it in. He says, hey, can you hold my 100 ounces? He says, yeah. But the problem is, if this guy ever comes gets his 100 ounces, it's all cool. It's come and grab in there. This guy wants to, which is obviously normally anyone that dealt with gold back in the day, had safes, had, you know, carrying transportation for all that weight and stuff and whatnot. Nonetheless, this guy, multiple say, hey, can I also put my 100 ounces in there? Okay, cool. Here's 200 ounces. But if you guys come in and out at the same time, I don't know how to keep track and give it to who. So he was like, okay, I'm going to give to these guys 100 gold certificate. And then from that 100 gold certificate, they can come in and claim their portion of the gold and whatnot. Now, obviously, this would be that intermediary type of bank. Now, Richard Werner says, and this is where he's, you know, Bob Murphy also says, this is where he's also a little bit wrong. He rebucks that anything else happens besides just credit creation banking. These types of banks still exist. They're escrow banks. It's your generic rental security deposit. It's your generic real estate due diligence or earnest money. Something that just goes into the bank, 100% tracked, and then comes back out directly to that person. Not your debit account. Your debit account's different than this situation. The situation would be that intermediary bank. Now, what happens when this bank says, well, I got 200 ounces of gold here, and what if I got another person that comes up and says, hey, can I have 100 gold certificate bank or just 100 ounces of gold? Either one, doesn't matter. Werner will go in try to explain the history and how it evolved and whatnot. But this guy needs 100 ounces of gold, or that value worth of things. This bank says, okay, well, I got 200 ounces in here, and these guys haven't came back to actually grab any of that money. So I'm going to give this guy 100 ounces and say, hey, I'll give you the 100 ounces if you give me an interest or some kind of repayment.
Until around 350 years ago, in almost all European countries, it was illegal to lend at interest.
Of course.
That's Christianity. Christian rules. You know, the Bible was against interest, and interest was everywhere forbidden.
Kind of repayment more than that 100 ounces because I'm taking that risk if these two guys come in and, you know, pull out money and whatnot. Roughly, he gives him 100 ounces. So the bank's down 100 ounces, but he still owes 200 ounces into these two guys. This is where you have that double accounting entry. When he originally put this 200 in there, there's another 200 on this side for the bank. This would be your deposit and checkable account. This guy comes in and he takes 100. He now has 100,000. Before we get into the accounting side of this, he now has 100 ounces of gold, and there's only 100 ounces in there. Obviously, you see the situation where, all right, well, this guy The bank has to keep enough cash in there, enough gold in there to be able to pay all three of these guys if they all come in and pull out their 100 and their 100. They would be obviously be negative 100 ounces. So what happens is, well, what's the collective percentage of how much actually comes in and actually gets requested out? And this is where you come up to the reserve. Well, let's just say it's 10%. Realistically, that's kind of what it's been. So the reserve is 10%. Hey, bank, you have to at least keep 10% of the deposits of that 100, 200 out there in their bank. So he can take this all the way down to 20 ounces. Why? Because it's 10% of the 200 ounces of gold that's been deposited into that bank. So you can have another guy come up here and he takes out another 80 ounces. Now, do you think these two guys actually want the heavy gold? No, they never wanted the heavy gold. So obviously the bank kind of incentivized them. Hey, well, why don't you just keep the gold here? You just need what these two guys have, those gold certificates. Much lighter, much easier to carry around. So that's what they get. Instead of taking the bank reserves amount out of the bank in case anyone comes out and grabs it. So he gets to keep his 200 ounces of gold in there, and again he gives these guys certificate and they get to keep the 200 ounces in the bank. And again, only 10% of the collective will ever come in and actually ask for the real backing there. Now you get into the history of, all right, well, now nothing's pegged to that gold. These gold certificates aren't pegged to an actual gold standard, aka the history of the gold standard and why that didn't work and why the gaming system changed at that point, and everything else. With this situation, you still have just that intermediary bank of this. What happens though is that you're looking at a screenshot of one bank with just their clientele. What happens now when you have two banks? Well, each time these guys come in, I only need 10% reserve and the bank can create money and just give these guys gold certificates. We've seen it, because these guys are on loans of these gold certificates and these are actually backed by real deposit. So the issue is that, all right, well, if this bank can do it, these guys can now take their gold certificates, come back, pull out that cash, that actual gold, and come over to the second bank. They can take their 100%, 100 ounces, actually cash it out. They come over to the second bank. And then what happens? Well, now he's getting 180 ounces in deposits, and what can he do? He can take only 10% of that, and he only has to keep a reserve of 18 ounces in there, and he can go re-lend out to more people. All of that difference between that and that, which is what, in the 160. So you may say, oh, well, when we put a cap on the reserves, it caps it to where, oh, these guys can only actually take out and lend this much on what the original 100 gold certificate is. But you can't. Because when you fractionalize it and you come over to the second bank, well, he can take another fraction of that and only keep 10% and keep creating money. Obviously, when it's 10%, how much can they actually break this, keep going down? Obviously, 10 times. That's where they come into the vocabulary of it's a multiple. Fractional reserve is just, what is the multiple of how many times they can actually fractionalize that money. Just by going bank transfer, bank transfer, bank transfer. So when you do that and you go to multi-steps of that bank and that money, that becomes a secondary bank, which becomes that fractional system. Again, Werner says, oh, well, that fractional system isn't how banking actually works. It's just credit creation, which we'll get into next. Bob Murphy is right on correcting him. The fractional system still works because, again, you still have those escrow accounts, which, again, if those escrow accounts are more investment accounts, where it's more traditionally like a trust for normal specific things to invest in, you could have those securities or that money or those gold certificates, again, go to the next trust escrow fund or the next secondary mortgage market, all this stuff, where you can still have this multiplication, the fractional reserve come out of that game system just by going down to the next and transferring it. That's how you can create money. Obviously, there's stipulations on creating all that money, the credit, the underwriting, and making sure you're not just giving it away and just creating money for nothing, all that. What Werner says is that, hey, on this is how it goes, because the bank already knows it can just give out the gold certificate. When they come in, they're not waiting on the deposits to just give out those gold certificates. Meaning this reserve number is not relevant. Meaning that it doesn't matter how much deposits come in, because when you grant these two guys as loans, you have to set up the accounting immediately. You're not waiting for those deposits to come in. They just set up a new account for these guys. And when they set up the new account for these guys, say it's the original just one guy, when he comes in and says, hey, can I have 100 gold certificate? He knows if they got 200 ounces and I can go up 10-fold, he knows, oh, well, I can take out, what is that? We'll say 1,500. He can take out 1,500 more than these guys can. And these guys are the ones that put their money into the bank. These guys are the ones that hold everything. Even whether they actually have the money in there or not, he can still get more than what these guys can have. Obviously, these guys can actually have the same thing. They just got to set up this guy's type of account and not this type of account. This type of account, when he comes in, he does that 1,500, they set up that double entry. They set up 1,500 because they have to give him 1,500. So on the client side of the actual deposits, they set it up. So he has that 1,500 coming in, and he's got another 1,500 on that liability. They take that 1,500 and give it to him. So that this, again, will show 0. Because they gave that to him. They still show it on the second bank account liabilities that it's actually 1,500. They create this step first before even taking anything out of this. This never comes down. It's separate accounts. This double accounting, Werner and Murphy, both, I think his first name's actually Robert, not Bob, but again, it's social media. This creation happens before this creation happens. So when this bank actually comes up and sets up his actual bank, he doesn't have to have, he can have 0 in the reserves and the deposits. And the deposits, he can have 0 come in when this bank starts up. And he can still lend out to these guys. Why, you say? Well, how can this bank just create that money? There's nothing in there, there's no deposit. Well, if you look at this bank that does have deposits, they're not using the deposits. These both banks operate the same. They're not using the deposits to actually make those loans. It shows in the accounting. Now, the difference between the fractional that Bob Murphy and the Michigan, whatever their university is, doesn't notice is that this happens before the fractional. Now, again, there are banking regulations, there are monetary regulations that they can't just create it and just give it to them. They have to have what, instead of reserves, they have capital requirements. Capital requirements are not reserves. When we get into reserves again is a type of money. When you get into modern money mechanics, they go through that. They heavily go through. Reserves is what it's all about. Because when you look at the fractional lending model, banking model, you'll see, oh, well, it's all about the reserve. Whatever reserve requirement is set is how much we can actually lend out as a bank, how much money we can create. And that's why the Federal Reserve, aka Reserve, you hear that name in there, all controls, all right, we control the reserve, we control how much money can expand and create. Because again, they know it can only get fractionalized 10-fold. That's the limit. So whatever they set the reserve, they know, oh, well, that'll only go 10-fold up for that percentage. Obviously, if it was a 50% reserve, obviously it can only move 2 banks. They can only fractionalize it twice. See where it's coming? So this capital requirement, you'd have to go into the definition of what they consider a capital requirement. And that's where you get into the types of money. This currency, paper money, is not just the only type of money. The Federal Reserve themselves will define exactly what that is. And that's when you get into economics of what M1 is, M2, M0, the categories of the types of money. Why this is heavily with foreclosures. You have to learn the type of money that deed of trust and that promissory note is. Just because it shows on there that it's a debt or a loan or a promissory note, again, go through these definitions and learn the banking side of things so you know, oh, this is what it actually is. It's not the deed of trust, it's a security assignment. For the types of money, you got cash, the currency, and then you got demand check or deposit. Those debit cards you have and the accounts they make for those accounts go towards that. It's considered N1. That's considered the supply of money that's in the system that the Federal Reserve controls. And you may say, well, the bank just creates money. This is where Bob Murphy and the Mises Institute says, well, still the supply of that reserve amount that can actually expand to tenfold or twofold if it's 50% or 10% of what the reserve set amount is, of what the banks, the Federal Reserve, the central bank requires. That's what actually happens. For other types of money, you still have things that we transact. Instead of gold, you may have silver. Instead of silver, you may have securities. Instead of securities, you may have Bitcoin. You may have all these different things that still act like money, but are classified differently because on the economics, we're looking at a full scope of what's happening in the full free market and how we can actually not control, but nudge and steer in the right way. For what the Federal Reserve normally did is hide their name behind that. The central bank is what they are, but they thought, oh, well, fractional lending is how the banking system works. We just have to control that reserve number. We see how they try to do that. And that's where you get into those interest rates of what is the Fed's interest rate, all that stuff. Let's get into that side of things so that we can actually look at, oh, well, how does America operate and how does the actual hierarchy structure operate to use these tools because they're also a bank. The government has their own bank. The government being obviously the Treasury, and then that Treasury's bank being the Federal Reserve. Now, the Federal Reserve, again, is its own bank. Even though it has the name federal in there, doesn't mean it's just the government controls it. No, it's a bank and it operates like a bank, and it's going to operate in the system, in the game that it's laid out in front of it. And when you use specific words and vocabulary like Federal Reserve, get into, oh, well, that's because they control the reserve rate of, when they control that, they know how much money can expand and deflate. Before we get into the next, how to prove that this, before getting into the next, how we prove that this system, the fractional system, just isn't there, is because this reserve amount, the Federal Reserve themselves, I believe it was 2020, is set to 0. Yes, 0%. Meaning, again, whether you're stuck on just the fractional reserve kind of theory or definition or how banks operate and still aren't on the full scope of the fine details of when that new bank opens, what they can and can't do, then it becomes, oh, wait a second. The Federal Reserve isn't what the Federal Reserve claims to be. They're, again, just a central bank. Once you get into the why, they say the banking controls everything. Even the society, the politics, what we do, what we produce, what we go, where we steer, everything. But yeah, let's get into the actual oversight of how more banks are connected together, because this reserve, again, they still have the issue of people coming in and saying, hey, give me at least all of the, it's not gold that we have anymore, it's cash and currency that we have in here, but hey, give me all that cash and currency so that I can go use it instead of just giving me the gold certificate or the receipt or the debit card. I want my actual cash. So this is where we're going to get into a little bit more fun things, the conspiracy side of things, and kind of where, I'm not going to say Catherine Fitz is on any conspiracy side of things, but the far reach of what she says everything or the intention behind everything is it's up there.
The underground base and city infrastructure and transportation system that's been built. And
I'm sorry?
yes. So we have built an extraordinary number of underground bases and supposedly transportation systems. Some of these are documented as part of the national security infrastructure. I think there are many more.
In the United States?
In the United States, and all over the world. From 2021 to 2023, I took one of the smartest subscribers in the Solaire Report network, and he and I spent 2 years collecting all the data and all the allegations on underground bases. We systematically went through and tried to estimate our guess, this is totally a guess, of how many underground bases, both underground in the United States, but also underground under the ocean around the United States. And our estimate was 170 with a transportation network connecting them.
And what would be the purpose?
If you thought you were going to get a near extinction event,
But a lot of this, what I'm going to go through, comes from the Fed's mouth themselves, the Money Mechanics book. And then you can see the same situation in the prices of yen and the system of money. But here, let's go through more of these definitions because, again, they get thrown out there and people don't know what's actually happening.
Banks don't take deposits and banks don't lend money. And there's rulings in English courts. What is actually a bank deposit? Well, that is to confuse people. At law, there's no such thing as a bank deposit. It's simply a loan. Well, hang on. A deposit is a loan? Yes, it's a loan we give to the bank. We give credit to the bank when we do what is called deposit our money.
Yes.
And that is the legal status. So it's like the tables are turned. So banks don't take deposits. We lend to them. And the deposit, a bank deposit at law actually is not privileged. But surely banks lend money? No. Banks are in the business of purchasing securities. And when you sign that loan contract, that's an IOU, a debt instrument that you've issued, and the bank will buy it. That's what's happening.
And can sell it.
Well, exactly. You can sell it. And also you will point out, oh, hang on, fine, these are details. This says I will get money. I'm borrowing money, so please give me the money. I don't care about the details. And the banker will say, you'll find this in your account with us. They may carelessly say, we've transferred it to your account, which is incorrect because no transfer happens. Your account will be credited.
You have the U.S. Treasury. Think of this as the person in the banking game situation. They're the government. They're the ones that are the actual government body. They're the ones that say, hey, here's the budget. This is what we're going to do with our finance. Here's where everything's going. That treasury is where you get, that national debt number, that 36 trillion number. We're going to come back to that number because that 36 trillion number is in the form of bonds and whatnot. Bonds and security and different things. And those bonds and securities is what pays the government. Those government contracts, those infrastructures, whatever the bills of all the government federal employees are, everything comes up and comes in there. And you can say, well, why is it 36 trillion? Well, it's 36 trillion because, currently averagely, I think it's 7 mil is the expense, but the government only produces 5 mil. So every year it's even going up 2 mil. Now, again, these are just facial numbers. We'll get into some of the back of what actually, let me write it down here. Shadow banking. The shadow banking is what ties to those foreclosure wars, the foreclosure theater. But to get over the broad scope of how things work, this government treasury body, that person still needs a bank. Again, it's a treasury. It sits and decides budgets and stuff and whatnot, just like a normal mommy and daddy, and they need a bank. The bank they use, government bank, would be what we call in America the Federal Reserve. The Federal Reserve is the same thing as what everyone else calls the central bank. These two are the same thing. In the scope of the diaphragm of the game, it's the central bank because all of those, we're going to put type 3 down here, all of these lower banks, those banks that had those reserve requirements, know just as much as everyone else that the game's on that reserve number. Whatever that 10% number is, that's how much I can expand and create money. So I really don't care so much about the deposits that are coming in from the people. Whatever that number is, I know I can get enough deposits that I can, go do what I need to do because I'm looking for those borrowers that I can just create money. But again, the deposit from these guys, whatever that number is, I can expand tenfold to these guys. The Federal Reserve, the way it operates is that what happens when everyone takes out more deposits than this bank can cover. And this happens, and it happens daily, even when these banks are just operating back and forth from each other. Because if these guys take out a loan and go put it in this bank, well, this bank needs the reserves from this bank. It needs the actual cash from that. You may think that's how that works, but it's not. All of these guys are linked to up here. So instead of the reserve number sitting down here, because it's a controlled federal central bank number, that number actually sits up here, right? Because all the banks are regulated by the same central bank and they set that number. So it doesn't matter. They still got to come up to that Federal Reserve account and they're all paying 10%. This is all digital. So reserve money is digital. What? Now, their vault cash is what this is called. So we'll call this vault. When their vault cash runs low, they need more cash from the Fed, and the Fed will give them cash, and they'll, again, change their digital reserve account number based off of excess or negative what they are on whatever that digital reserve account is. So even when they create that deposit, there's also a digital reserve account money that is created. That is still money. This is what used to be called the highest power of money. Why was it called the highest power of money? Because they knew whatever that amount of reserve is of what a bank has, they can multiply it whatever the current rate was of set by the Fed. When they actually give the cash out to them because they're negative down here, that's what gets charged, and they get charged an interest rate on that. So say the Feds need, or this bank or that bank needs money, the Feds are going to charge them an interest rate above what they have on their digital reserve account on that. Now you may say, oh, well, that interest rate that they set is based off of, you know, whatever these banks want to actually lend out. Because if they purchase money from the Feds outside of this digital reserve, just on the normal market, so that they don't got to worry about their vault cash, they can purchase cash from the Fed. They don't got to worry about deposits, and then they can actually, again, reloan out to all these guys. Oops. For this, are the two ways that the banks are going to lend out. Again, the bank does not need deposits from accounts. They can get cash liquidity requirements from either on their digital reserves or just purchasing cash from the government. And that's where he can actually multiply and give out the money. And that's why the highest power money used to be digital reserves. But the Federal Reserve set that to 0. And that's why, again, the fractional reserve system isn't the system that the economy fully is operating under. It's more of the credit creation source of that is what it's operating under on. And that's kind of how the Treasury interacts with that and that. Now the Federal Reserve used to control just this, and you can see, well, if I set it to 0, they can control it and still increase it back up. But they've, through the years of experience through COVID, they understand that has nothing to do with the system. If you were on a fractional reserve economic system, that would control everything. But again, that's not what it's on, and Bob Murphy can, I don't know if he's up to date with things since 2020. I don't think Werner is too, because he's, again, still trying to prove this and explain it. Just show, look, a fractional reserve 0. The supply of that demand and that cash or capital does not care about M1. Why? Because Federal Reserve have other options to control that money supply. How do they control that money supply of the cash? They're not worried about people just purchasing cash. They still have, again, they're a bank that operate just like these guys. They obviously have a different clientele, the government, and everyone else. Don't think that this is just an exclusive government bank. No, this is a central bank. That central bank operates just like these guys, and they want to invest to other, maybe not these lower class people, but they invest into, let me give them a different color. They invest into other businesses and other investors, just like these banks do. And just like these banks do too, they can also purchase the securities and bonds, just like everyone else does. It's an open, free market. Just because the Fed name is on that doesn't mean it's an exclusive government bank. And that's why they say, why does the Fed have so much control, aka the banking have so much control on the actual government? Well, you can see just by setting that number, the repercussions it has in the economy. And just setting this number, what everyone else is focused on, whatever that interest rate number is, this interest rate number has nothing Nothing to do with you. You don't even still understand what digital reserves are and what real digital money is. You're still stuck on also this deposit number to make loans. Just not how loans work. Yes, banks create money, which not just on the fractional reserve of economy movement, but literally from nothing. If this guy has zero, he can still have equity inside the original bank owners to start the bank, and he can still lend out money. He can still create money from nothing. And when he creates that money, it's not just him that creates it. It's also, he needs a client. So he's got to also obviously coerce or get a client, market to them politically wise, culturally wise, whatever, to unlock that money creation. But obviously, this guy is ultimately the one doing all the work to create that, to back that up. So as they create money, they're creating demand that has to be fulfilled, which is what people look at this 36 trillion. But this 36 trillion is just, again, facade M1 money. When you look at the other money, the securities, the reserve, it gets up to, I think, 267 trillion. That expansion of money, that expansion of the cash currency, that M1 money, is just what you see on the open public market from government banks or central banks. This game is also played by individuals with other individuals. And that's where you get into Catherine Fitz's shadow bank. Even this number isn't really considered the shadow banking that's going on between parties and parties, businesses and businesses, not even on the banking system. And that's why Catherine Fitz is very, very big on the control that they're looking for just within the banking system, which obviously gives them a lot of other economic, political control, which gets into more of the conspiracy side of things. But again, just the shadow banking, just that word alone, has cultural public connotation of conspiracy for some. But it's all these securities, which we didn't get into, that happen to why there's a way bigger number than just the physical cash out there. And that bigger number is our main issue of banks just overinflating things, saying that you're going to create 100,000. Well, guess what? The market says it wasn't 100,000. It was 50,000 that I created. Can we resettle? And I'm showing you that the market is saying that it's only 50,000. It's not 100,000 demand that was created. We were both wrong. And that's where you get into foreclosures of, one, where did the money actually come from? So if you're in the smaller intermediary systems, like an actual person, you're actually just one party lending out to money, absolutely. The debt should obviously last as long as possible and be there. The issue is the control on the inflation of, well, we all thought it was 100,000 and we all created it out of nothing. Why am I getting hounded so much? Why am I getting stripped the worker out of everything? And the person that created the money out of nothing gets everything. It's not how it works. And that's some of the weight that we're going to try to peel back for homeowners to also take down that moral equity situation. This game is just 2 layers right now. It's 2D. Once we start getting into actual equity of, hey, this is what's happening, and we need to renegotiate what everyone has speculated on the money that we created, the loans that we created, that speculation of getting that demand back, the market isn't valuing that demand anymore at what it is. That needs to get renegotiated. And there needs to be something inside the system game that's not your current bankruptcy. Even the words used for it, even though it may be just restructuring of debt, needs to get changed. So let's get into how this actually involves real estate and why real estate's the biggest issue. And I don't think Werner actually does a good job in Tucker Carlson's podcast of why it's attached to the real estate so much. Even in these movies, they really, again, aren't attaching it so much. I think Catherine Fitz has more of the understanding, but I haven't been able to find actually some of her stuff. She has her business Solaris reports, or I don't know, I haven't dug into it, I haven't had much time. But she's, dealt with mortgage fraud and been trying to fix it her way. But first, let's get an understanding of how that actually interacts with banks. Okay, so under 5 minutes, we're going to go over how this actually interacts with real estate. So for this banking guy, again, I'm going to throw this depositor over here just so that he's in the mix and you get used to him being in the mix just like you normally are. But again, credit creation, this guy actually doesn't matter. But for the bank balance sheet, we're going to look at this, the double entry. So when this guy comes over here, this bank's already operating. He's got deposits. This guy came over with $100. The bank on his account has $100, but only keeps $10 liquid inside his actual account. He's got two sides of what's actually on his account. Same thing when this guy comes over, but this guy's opposite. He's not going to do a deposit. He's going to say, hey, I'm going to do a deposit of $10,000 so that you have reserves to instantly give me the $100,000. Make sense? More than that, I'm going to give you something that's called a deed of trust, because hey, the security behind you doing all this, the trust that you can put behind all this is that I have this property, and that if I don't pay you back, you can go foreclose on that property. You can force me to sell that property to pay you what you are owed, your $100,000. Now remember, the moral of the story is that this guy paid the bank, and that guy's money is what pays this guy. What happens, again, double entry. This guy comes to the bank. This guy obviously has banking credit requirements. He underwrites it, says, double check, you're a good guy. You're giving me a payment so my reserves are met and I can give you, I can create you that extra money, that $100,000. Now, obviously, you have an additional guy over here is what sells the property to him. So he needs to actually give him the property for him to actually give him also the deed of trust. When he does that, he's going to give him two things. They're swapping. Just how this guy gives the deed to him, this guy then is going to swap. You give me the $100,000 and I'll give you $10,000 plus a deed of trust that's backed up by the property that's worth also $100,000. But right now, I'm just going to put deed of trust here. But we all understand that that's worth money. Why is it worth money? More than just it being tied to that property. For the bank, he again is creating and increasing his entire balance sheet with nothing. He's got no new additional deposits coming in. He's using the deposit from this guy, which gives him to inflate everything. And when this guy comes in, again, he's not touching this account. He's going to come in and say, here's $100,000 of cash, and then I'm going to give you also on this side, double entry. I have to set up, again, your deposit account that says there's at least $100,000 in here. And why is this $100,000 here? It's always alive as long as this deed of trust is alive. You can consider more than just the accounting aspect of the fictitious making of the account. You still have this deed of trust. So what does this all mean? One, that the homeowner's demand is what authorized the bank to create the money. So therefore, it's the homeowners that are creating the money. Now, this is a deed of trust that's backing this fictitious, again, it's separate from deposit. It's not, again, he had to give him actual physical cash, especially if it's going to the seller and he's actually pulling out cash and it's not coming back into this bank or the banking system, then obviously there's issues. But all these banks are connected to the central bank and they're all regulated and they're all reserves and everything. Money's all tied together and their accounting's all tied together. Once their accounting's tied together, they're a part of a system together. So this system works when it's just a bank that's part of it and tied to the system. But what happens when it's not at a bank? What happens when it's just another person and he's operating and trying to do the same kind of situation? It becomes an issue that, hey, this fictitious money isn't as fictitious as it should be. And it's more of an intermediary bank than this more lucrative type of bank. This type of bank relies on the homeowner's demand and the security behind this number, this fictitious number. With real estate, it's deed of trust, which actually has a physical property, which is a lot more stable than other assets. But this security can also be different things. It can be a business, it can be a stock, it can be other things that he's giving him, a vehicle car title that's going to sit there and act as that fictitious number or security behind that. If we can't get the money back, well, we at least have this reality of a physical thing already attached to the demand that was made. But to say that the banks are giving other people's money to other people to lend out, it's not. It's the bank's money usually. And more than it just being the bank's money usually, sometimes it's even the individual characters, especially for homeowners. When you have a 20% down payment, do you think their reserve for that is 20%? Do you think the capital requirements was 20%? No, you just paid the bank to create the money in the system, the game system, the banking system. You need to start flipping those realities and perspectives because, again, you're not borrowing 100% of this guy's money. You're borrowing maybe 10% of this guy's money at max, even if that's how the smaller bank is set up. And then all the money from this pool, this capital, is coming from different liquidity issues, from the bank, from this guy, from other reserves that gets capitalized, other different things that you're not just pulling out just actual hard physical deposit money cash. There's so much inflation of digital money, of fictitious money, that at the time that it was put in there, it may have been backed by something. But we know how many times things get misvalued or things, or the market shifts and we start devaluing this. Well, the demand that we thought we were going to pay back has to get renegotiated, that it's not so much of a spread, and that the homeowner isn't the one totally at fault. The market may be at fault, the asset may be at fault, and more than it being at fault, it's not hurting this guy directly. It's hurting more of the fictitious assumed amount that was created by both the homeowner's demand and the bank agreement of that demand. And when that demand's value shrinks, well, that account also needs to shrink, not keep increasing and increasing because of interest. And this homeowner has to fumble around to try to figure out, where the hell am I going to pay for even this additional interest on all of this, because this guy says I owe him interest for making money that he can't make without me. And to be able to set all this up is paperwork. We should not be giving so much cash flow and money to this guy when it's paperwork. And I think that's where the centralization is going to come up inevitably, and that's where a lot of that, if we focus on the positivity of things instead of the negative things that Catherine points out a lot, tries to warn people of. And I think she's doing a blessing to actually bring light to it, so it's an awareness. But I think we need to focus on, hey, how do we actually fix this game? Warren, thinks it's still more quantitative easing, structured quantitative easing, and tightening. And okay, that's just our current system, bailouts of stuff, just changing the balance sheets of all these banks that are all connected together. The issue is that these banking systems isn't accounting for all the individuals that are working individually together and creating their own money in the economy. This fictitious money that explodes and explodes, that is getting circulated more. And these banks obviously are the flow of currency, that M1 capital, that the demand of the individuals operating in the economy outside of the banking system is creating. So if you go on the money mechanics, they still say that people in the economy create money more than just banks do. Yet all the cash flow comes through, the currency comes through the bank. That's why, again, digital currency is such a scare for also the banking system, because if we created a system outside of the banking system of currency that didn't rely on this, then this wouldn't be in control of, or at least trying to control, the economy. And we'd be more focused on allowing these banking systems, the structures of the game, to individuals use it as money multipliers for themselves and not be charged and predatory input into spots where there's no decrease in the demand and that demand value getting repaid. Hopefully that all made sense. Hopefully I wasn't just rambling on there. I know a lot of these gets, little coloring at the end. But please go look at Richard Werner, his Tucker Carlson podcast. Then go look at the critique of that with Bob Murphy. Show them some both love. Subscribe to their channels. share their channels, actually share this video to each of them, especially Tucker Carlson. We really, really need to get the credit creation model of banking out there. Yes, fractional reserve is still out there, and it's a maneuver procedural game, but the credit creation of that double accounting, even Bob Murphy has that double accounting teaching in his teachings, needs to get out there so that the reliance on, oh, Bob needs to pay Schmo. Well, no, we need to discuss this inflated, huge number of created money before we get back down to the principle that Bob or Schmo needs to get paid back. Because if we don't, we can't have healthy conflict to reduce demand. We have to continuously be 100% full force, always creating, always scaling. And we can know through any individual life cycle that that's not individually capable. And I think as a group of society that, again, many countries have shown isn't available. Booms and busts aren't there. War, all that stuff. I'm not saying conflict has to go away. Conflict can come back into the game and competition, getting more creative of how to compete with each other. But this system needs to be freed up, that the individuals take back the control, that they know they're the key. I think we've kind of seen that in COVID with the feds trying to control with the pieces that they have of pushing more cash in there, which, everyone has the inflation, scenario or game story in their head, or controlling the reserve rate, and all these different little aspects. They don't. The control is in the private market. And the private market isn't going through all these centralized banks that feed up to that Federal Reserve, that feed up to, hey, we can kind of look at everything and see where everything's at. No, you cannot. There's so much more money on the private side that doesn't include this bank right here. It includes a person. And the same game and system gets played out. Obviously, not so much on the fractional side with him being a person and connected to all the banks and the reserve numbers and stuff. But this credit creation model can still actually happen. And that's what's happening and why there's so much shadow banking behind the scenes. So much that's not on that 36 trillion national debt number. There's so much capital out there, and that's what everyone's worried about, of a crash of, even if we can't get the banking system right, we know all the individual players can't get it right. Well, newsflash, the players do have it right. What you guys are lacking on, maybe getting out and actually participate, actually putting your foot on of, hey, why the game should get structured this way or that way. Because I can tell you about Murphy, Austrians do not have it right either. One, you don't even understand the credit creation difference between the fractional to where, it's all over your head. But I give you props though. You guys are out there teaching some of the basics. But the key points, the difference between concrete, cement, flour, dough, deed of trust, security assignment, those nuances matter. And hopefully this is good enough for you. If not, please go find our book, The Real Game Made Simple. And like, subscribe, show some love, and hopefully, if this adds clarity to the conversation or the economics, hopefully that this will get to where it needs to get.
So you had the wonderful Richard Werner on your show.
Yeah.
And Richard has a book called The Princes of the Yen, which is about the sort of effort to take over the Japanese central bank. And I think what you're looking at, I think part of the state of play with both Russia and Iran is how are you going to make sure that those central banks are entirely in the system?
So, that was an amazing interview. And he told the story about writing this book on the Japanese central bank. I can't imagine a more obscure topic from my non-economically minded standpoint. It'd be like writing a book on postcards from the Falkland Islands. It's just like, okay, a book on the Japanese central bank. And he said, well, actually, they suppressed it. I couldn't get it published in the United States, and you can't get a copy. And that's like checkable. So I checked it. You can't get a copy of that book. It's really hard.
I think you can order from its publisher right now.
Okay.
Right.
But I mean, like, why would someone try to suppress
because
a book?
it shows you the true. It takes you right into the secret governance system, and it shows you the primary mechanism by which they implement policy.
Yeah. Well, it's always the things you're not allowed to say are probably the important things.